Welcome to the FFS podcast, For Finance is Safe, the show that challenges the status quo of accountancy and business. We're here to break down barriers, remove the gatekeeping and freely share the kind of practical advice and insider knowledge that most people keep behind closed doors. Welcome to our property podcast. This is episode 1 of our property podcasts. So you think you're a property investor. So is your buy-to-let dream actually a cash drain nightmare? I'm Rachael Chadwicks Harrison, the MD, founder and chartered accountant of Chadwicks Accountants and Bookkeepers Limited. And I'm sat here with my colleague, senior accountant James Montague. Say hello to our listeners.
Hello listeners.
So Monty, how many clients have strutted into the office thinking that they're the next property mogul, only to leave clutching the spreadsheet and a headache and their property dreams in tatters?
Surprisingly more than you'd expect. It's not only our clients that come into the office here. We often have people come in just off the street asking for advice when they suddenly encounter costs and additional fees that they've not previously anticipated, and basically just looking for that extra bit of guidance.
It's amazing how many people don't realise the cost of the stamp duty and the solicitors and how it all racks up.
It all creeps up on you, yeah. You don't realise until you're actually doing it and you go through the process, and then suddenly you're like, wow, oh my god, where's this all come from?
I think people really get carried away, don't they? They see something they like and think, oh, I can afford that and I'll go buy that and I'll deal with the consequences later. Yeah. We did have a client walk in here a few days after his baby had been born on the way back home from the hospital, and then he popped in to say, I've just been in the auction house, I bought a property, I need a limited company. Yeah, I think a bit more planning is generally the right thing to do. So what we're going to do is we're going to talk through a example that many a client comes with us with, and we're going to show you how that actually works. So hopefully, listeners at home, you can put together an example yourself when you are looking at purchasing an additional property. So we're going to be looking at a property that's around £250,000, and we're going to say you've got a 25% deposit. That's £62,500, so it's not insignificant. What sort of mortgage interest might you pay on that, Monty?
Well, for a buy-to-let on that sort of property, you're looking at about 5.5% mortgage interest over a 25-year term.
Okay, that makes sense. And in our example, we're going to assume that you're not paying a regular estate agent fee, you're living the DIY landlord life, because they will take an additional, generally 10% at least of that rental income that's coming in. So on a property of that size in our area, you could expect a rental income of around £1,200 a month. On that size mortgage, you would pay interest of £860 a month. Then you've also got to pay for insurance, accountancy fees, servicing the boiler, pat testing, all those sort of things. And we're going to round that in at around £125 a month. Now that gives you what we accountants call a taxable profit of £215 per month, or basically £2,500 a year. You're then going to pay tax on that. Assuming you're a basic rate taxpayer, the tax is going to be just over £500 a year, or £43 a month. Now let's assume you don't go down the interest only route with that mortgage, because at the end of the 25 years you actually want to own the asset. You don't want to still have that huge mortgage. Then you're going to have to pay mortgage capital, and that would be around £292 a month. And that effectively means that every month you lose £120, or every year £1,440. And that's a loss without there being any of those one-offs, when the boiler breaks, when the flooring needs replacing, when something goes wrong and you've got to replace that. So you're already in a cash loss.
Yeah, and just an example, thank you Rachel for that. In that example, we're just looking at you as a basic tax rate payer. Now, let's say you're a higher tax payer, you're going to end up paying 40% on the taxable profit there, which will, in that example, double it to £86. And then similarly, if you were a company, it'd be 25%, which again is an increase on the tax that you'd be paying, and therefore your cash loss will increase. Therefore, you're going to be spending more money trying to maintain this property.
Yeah, you're even worse off there. So yeah, if you decide to go down that interest only route, you're never going to own the property either. It's a lot of risk for a passive 2k a year, and obviously that's even less, like Monty says, if you're a higher rate taxpayer, getting that capital and interest mortgage does make more sense overall because you'll own the property at the end of it, but you are just leaking cash.
So I've just got a few questions then I'd like to ask you, Rachel. Where's the passive income?
Well, there isn't really any passive income in that. There's a lot of stress and headache. And if you wanted a true passive income that you didn't actually have to do anything for, you have to pay the estate agent fees, which is going to erode any cash profit there anyhow. So no, there is no passive income in this example. And as you mentioned, the 250k is sort of the minimum property value a lot of clients are coming to us looking at. Many of them are looking at much higher value properties, and the figures actually tend to get worse.
So you paid the deposit on this building. Are you then stuck there with that forever?
Well, if you stick with it, it's not really an investment, is it? It's just a slow leak in your wallet over time. If you have the readies and you're perhaps in a high-end job or you're making a lot of money, you might see that as a long-term investment for, retirement, and therefore expect the cash loss, be prepared for, be able to service that cash loss, and you have the property at the end of it. That could make sense. But for the average investor who's generally looking to make a passive income, now most of the clients that walk through here, they seem to think, oh yes, this property is going to make me £1,200 a month. They seem to consider everything else. It doesn't work out. And I see more and more people, especially as the lovely low interest mortgages have faded away now, start to sell those properties because they're no longer sustainable. And unfortunately, they're only finding out when they do their tax return.
Yeah, that's spot on. And in your opinion, would you recommend this to any of your friends or family then?
God, no. Well, maybe the ones I don't like. That is the investor litmus test, isn't it? Would you recommend it to a friend or family? God, no. So, Monty, I have a couple of questions for you, actually. Do you think clients understand that mortgage capital repayments don't count as a tax-deductible expense?
No, they don't. They don't normally. They don't understand. In their mind, they think that it is, but it is not. You can only claim the mortgage interest in your tax-deductible expense. The mortgage capital is not, and that's what catches a lot of people out. They misunderstand.
And it makes perfect sense, really, because the mortgage capital is like an investment. It's then like paying into your savings account. You don't get tax relief when you pay into a savings account. So why would you get it when you pay a mortgage capital repayment? No, it does seem to be more and more common problem that we have. So if this was someone's plan A for retirement and it clearly doesn't work out, what's plan B? Work until you pop your clogs?
Well, I mean, in that situation, obviously it's just the cash, but it's just bleeding you at the moment. So what I would probably recommend is looking to sell and then going and seeing a financial advisor and talk through your options with them. There's plenty of other options out there for it. That you can spend your money better elsewhere. Definitely recommend that, especially when in a situation where you're this person in the example we've given. Maybe sit down, reconsider your options and think about, is this really what you want to be doing?
Yes, if you can't afford the cash loss going forward, perhaps that money would be better off in a pension fund, a savings bond, depending on your level of risk. And well, as we say, we're not financial advisors at all, and we do ourselves invest in weird and wonderful things.
Yeah, I've made a few bad investments myself, so definitely go seek.
Don't come to your accountant for financial advisor advice, just tax advice. I mean, I keep looking at these whiskey casks you can buy, and I think that looks interesting. I'm not sure if it will play out. Well, in summary, you need a lot more than a 25% deposit to make a property investment a really viable option. And don't figures before you start putting offers in, please. So I just want a little cheeky segment before we go, Monty. The landlord myths we love to hate. So tenants pay your mortgage.
They don't. That is false. They don't get caught out.
Property values always go up.
They don't always go up. They do in some cases, but not all of them. So again, don't fall into that honey trap.
Yeah, and that's a problem if you've got an interest-only mortgage, isn't it? You might end up in a not very favourable position and owe more than you have. And you can offset everything against tax.
No, completely false. So the way to think about it for this is any changes improve the property will not be tax deductible. You'll be taxed on those at the point where you sell the property. But if you think about things like repair, leak in the sink, for example, that is tax deductible. You can offset that expense because you are fixing it back to its original stature or how it was in the first place. You're not actually improving it in any way.
But if I went and put a jacuzzi in and made a really nice bathroom, that's not a repair and maintenance.
No, that's just increasing the value of the property.
So I can't offset that against the rental income.
It'd be great, it'd be lovely.
I mean, the tenant's going to really like me. I can't actually claim that until I sell the property later. Well, thank you for clearing that up, Monty. That's very handy. Thank you, listeners, for tuning in this week. Hopefully you've all learned something. And if your property investment does pass the calculation test, then tune into our next property episode on smart structures, how not to regret your property investment.